Welcome back to my channel, guys. Today we're going to talk about Voyager Digital Stock. They've just released their earnings for the quarter ended March 22. We're going to look through the numbers, going to dissect the revenue, going to look at, other growth metrics and the profit and loss as such as well, but also look at the balance sheet as they have been announcing a capital raise. So we're going to see, is there any issue here for investors? The stock price has obviously reacted in a negative way, sending the stock down to new all-time lows. So we're gonna have a look through the earnings here, which I've pulled up to see what's going on. Should you be worried if you're an investor, or if you're potentially, looking into investing into this company? Is now the time to buy here? Obviously, we reached a new all-time low at $2.30. Sending the stock down, new all-time lows after hitting highs in last November, and now we're looking at a market cap of around 500 million Canadian dollars, which cut the company in half again, which was just recently around 1 billion, now in 500 with the crypto headwinds and with kind of disappointing earnings. So let's head into the headlines of the earnings. So we've got it here on that side. So basically, revenue was up from, this is compared to last quarter, March 2021. So revenue was up, was 103 million. So first time reaching over that 100 million, up from 60 million in the year before. The loss was slightly less than before at 61 million, but still a massive loss if you think about the size of the company. Over 10% of their market cap as a loss per quarter, which is quite significant. Adjusted EBITDA, so earnings before interest, tax, depreciation, and amortization, was also more than last quarter or last year's quarter at 53 million compared to 48 million before that. Funded accounts though was up, so even in that downturn we will see later, they've added quite a lot. They've added 115,000 new funded accounts, so accounts that are verified and have put money in there. They were up, so we are looking now at around 1.2 million funded accounts versus only 274,000 in the year prior. So obviously significant growth here during 2021 of funded accounts, and that's just one part of why people were so excited, because they're basically growing this company from zero to now over 1 million of funded accounts. And it's not, even though we have a downturn in the market right now, it's not expected to slow down anytime soon. You see here assets now at $5.8 billion compared to $2.5 billion the year prior. So more than double the amount of assets that are sitting on the platform right now. So even though we will see that trading volume is down, the numbers of assets held for the customers has increased as people moved onto the platform. More people moved onto the platform and actually funded quite a lot and used the platform for the staking and reward program. Other than that, not much to mention. Obviously, earnings per share is negative. It's slightly less negative than the year before, but that's not something we really focus on at the moment, as the company is making a loss anyways. We expect it to be negative. They say obviously equity is more, it's 260 million compared to 98 million, which they've raised a lot of money there. But I want to start off talking about revenue in detail here. As we can see, they've added a lot of new revenue streams to their profile, which obviously helps them to generate more. We can see that revenue, as we said before, has increased to 103 million compared to 60 million the year before. And we can see that this is mainly due to those new revenue streams added. So they have merchant services where they get money from merchants from paying via those merchants. They have staking revenue now at 14 million and other revenue at 5 million, because you can see that overall the number is up, but the actual key revenue item, which is the transaction revenue, is down significantly from March 21. And when you think about March 21, we only had around 300,000 customers around that. So 200 to 300,000. So for it to be that much down, that just speaks, worlds around how much the trading volume had come down, because we're now looking at triple or quadruple the number of customers on the platform, and the number is down almost 50%. So that just speaks a lot of how low the crypto interest is at the moment, and it translates into very low trading volumes. And obviously the trading volume, that was one of the key things that would Voyager makes revenue from. And here we have the different streams. I thought it would be good to just go through it and explain what is each revenue actually. So the transaction revenue is obviously the revenue derived from providing execution for customer-initiated crypto asset orders to buy, sell, or transfer. So this is whenever you move or you buy or sell your crypto. So they're making a little fee on that. Then what has expanded significantly this quarter, as you can see, is the fees from crypto assets loaned. So they have been expanding their loan program and have now, they obviously earn a fee if they lend their crypto. So they let you stake the crypto, park it there, and lock it in. And while you're doing that, they lend it out to other people, to institutional borrowers, to qualified borrowers, and they make a fee on that, which we're gonna see later down here in this report. They actually break it down, by segment. They're showing you what is profitable for each segment. So, and then the merchant services, obviously, as I mentioned before, merchant services revenue consists of fees a merchant's customer pays us to process their cryptocurrency payment transactions, and is recognized upon completion of the payment transaction. So this is just basically an in and out fee. As you can see, it almost nets off with the cost of merchant services. So they're only making a really small profit on that. Staking revenue is, we also generate revenue from crypto assets through various blockchain protocols by either participating in the staking programs offered by the financial institutions, delegating crypto assets to the staking platforms, or staking crypto assets directly with protocols and smart contracts. So they're making, themselves kind of a staking revenue there by holding their own cryptocurrencies and their own coins and participating in multiple various staking programs there. And they have some other revenue here, which is not that significant to mention as of yet. But what I want to get into here is the actual breakdown by the types of operations to see how profitable we are in terms of each revenue stream that we are having. So first is the transaction revenue. As I said before, that was always the key one, which has dropped significantly, 20 million. The explanation here obviously saying largely driven by trading volume and transaction spreads. During the quarter, trading volume decreased by 30%. So yeah, this is just basically saying the crypto industry, the crypto trading volume has just been significantly down. That's something that's not really controlled by Voyager as such. That's just an industry-wide phenomenon that we've seen, that the interest in crypto has come down significantly, and so that trading volume as well. So if they don't expect high volatility to the upside and downside, there's less trading volume. So when you see a period where, for instance, Bitcoin is just trading around at 30,000 and doesn't do much, that's actually bad for Coinbase, Voyager, and all these other exchanges, as they don't make money from people just holding it in the wallet and not moving it at all. So this is why it's down. And then you can see here, if you actually think of the trade expenses that are directly relating to those revenues, so this is how they're broken down, and then also customer onboarding and servicing costs, they actually are profitable on those transaction revenues. So obviously the profitability now going down with less revenue, but still significant profit here that is derived directly from that transaction volume, which is 32 million for the quarter, and for the year to date it's 154 million compared to only 54 million the year prior. But yeah, you can see that the average transaction spread is down. Trading volume is also down for the quarter compared to last quarter, and you can see, excluding stablecoins, a significant drop in trading volume here. Okay, the next one is the loaning. So the fees from crypto assets loaned, which obviously they have now expanded their loan program and have generated way more revenue from that side. Fees, crypto assets loan 31, and staking revenue also relating to that is 14. But what you also can see is that rewards paid to customers. So you hold your crypto assets on there, you are promised a certain reward level for holding it for a given period of time on their platform. You are expected, or you promised a certain reward, and this is the reward they've been paid. 59 million compared to they've only generated fees of 31 and 14. So they're actually running at a loss of 14 million by you holding your assets there while they're trying to make more money. They're trying to be sort of a pseudo bank, trying to make more money while they're holding your assets for that 3-6 months period. And before it comes back, they're basically wanting to generate more money from that. So they're still running at a steep loss here, and year to date it looks really, really bad. 58 million loss from there. So rewards paid to customers just 182 million. That's like crazy money being paid out to the customers for holding their assets. And I think that's how they've been able to attract that many customers, because the rewards are so high. So that's why a lot of customers move to the Voyager platform. But obviously, as you can see, it's not really sustainable at these levels. So fees only 81 million, staking revenue 43, running at a $58 million loss. Obviously, that's not something they can do going forward. So there has to be found a way to actually scale that up, to make more fees through the loaning and to make more revenue from staking as well. So I think where the opportunity is here is in the loaning out to the customers. As they loan more, that should increase here. And rewards paid to customers, they've announced on May 1st a tiered reward structure for Bitcoin, Ethereum and USDC, which means that you can't just get the same amount of reward by adding more and more money. At some stage there is a level, there's a ceiling after which you only get, let's say 1% instead of 5% before. So for each additional dollar you get less. So this is obviously something that's really important, because they can't just have people coming on there with millions of dollars and getting a huge amount of interest paid. It's just not sustainable. But yeah, what they've also called out is they've also obviously increased that loaning by growing their lending program and increase the number of crypto assets generating a yield. So their lending program is for something that they in the earnings call have always called out as well, and mentioned that they make some significant progress there. They're obviously only looking at qualified institutions here that they borrow money to, so they're not just lending it to anyone, which reduces the risk as well. So as soon as they can expand on that, so that actually the rewards come down a little bit and this goes up, that they can actually make a profit here, then it would look good. But at the moment, this is a huge driver for the loss that we've seen. And then on to the next revenue stream. So merchant services revenue, as I said, that's only really a small part here, although the numbers seem good and they increase from year on year. And last year we didn't even have that. The profit here is very small, as obviously the cost and the revenue almost nets off for merchants here. Not really something that you can count on. Then we go to other administrative costs here. You can see that compensation, employee benefits and share-based payments have risen significantly both, which is already, which is to be expected as they expand significantly. They have added a lot of new employees, have increased their headcount from 239 employees to 318. So as they increase the headcount, obviously share-based payments and employee benefits compensation goes up. It is a significant increase, as you can see. So you can see it as a significant investment into Voyager's future here, that they obviously going to expand and hire appropriate talent here to really expand and grow the platform to a significant player in the market. And we can see that 239 more employees, which translate into 22 or basically 30 million more costs relating to that. And then we have professional and consulting expenses up by 18 million for the year to date, which is primarily driven by the increase in advisory and technology consulting expenses relating to the growth of the business, but also the Coinify acquisition that happened last year. And then general and administrative expenses is not really a surprise as such. If you're growing at that pace with that significance, you're obviously also going to incur more costs relating to technology, recruitment, investor relations, insurance, and other expenses. So, I mean, that's just to be expected. We have to always see that it's sort of in line with revenue, that it grows not beyond that. Same with marketing expense and employee expenses. But at the moment, I mean, that's not really something alarming here at this stage. And then overall, they have here the total revenue and total expenses, excluding marketing and sales, that are related to those revenues. So basically the cost of sales as such. And you can see we're around $350 million for the period. The cost for that revenue is 335 million, so almost, nets off. So we're having a profit here of 14 million just based on the operations. But then obviously we have a huge marketing and sales effort here coming in, eightfold from last year, at a $82 million, bringing us down to a loss of 68 million for the 9 months ended March 22. What's sort of surprising and concerning as well, obviously, is that revenue just increased by maybe 5 times, whilst marketing expenses eightfold. So this is quite a high increase here. We're looking at even from only 66 million and 31 million cost, we were running at a 34 million profit and actually 24 million clean income after marketing expenses as well, whilst now we're running at a negative 68 million. So obviously there's been huge efforts of participating in general different things that, like different sports, to bring the Voyager brand out there, to actually generate that. We've seen that from a lot of others like Crypto.com and Coinbase as well, where they've actually bought stadium name rights and things like that just to bring it out there, just to bring their platform out there. As obviously there's so many different crypto asset platforms out there, you really have to get your name to be seen by a lot of people to actually build that brand recognition and brand awareness. So I think that's why it's kind of necessary at this stage. Obviously that's also not sustainable, the same as we had that other loss, but so we can't just eightfold our marketing expenses each quarter. But they've been talking a lot about cost cutting in the call to actually find efficiencies. They say that the marketing spend is very efficient from their point of view compared to other platforms. But what we see purely by looking at the numbers is that it just doesn't add up. I mean, we have eightfold increase here, but it's not an eightfold increase in revenue that was derived from that marketing sales. So it seems to me that 10 million was more efficient last year than the 82 million now, because I mean, obviously there's less interest here, so you would have to have more effort, more incentives for people to actually come on there, because it's not that someone has just heard of it and just wants to jump into crypto. You have to actually convince them way more than last year to jump into investing in crypto and to joining the platform. So next one, we want to look at the balance sheet. So that's obviously one of the concerns here today, because other than the earnings release, which has shocked obviously investors because of the lower trading volume and the lower revenue that derived from that, there was another announcement made that the company will offer to some existing investors 60 million of additional shares, basically doing a capital raise here, bringing equity up to about 60 million to have some additional cash. The cash was meant to be for only it says general corporate purposes, so it's not that they are raising cash for a specific purpose, for a specific acquisition or strategic move that will make them better or more profitable in the future. It seems to me a move that is just purely out of caution. They want to get some more cushion here, cash cushion, to actually be able to perform, to operate for the next 2 years. As we see here right now, cash on hand has reduced significantly, about 100 million from last year. Current assets now sitting at $5.9 billion, whereas the current liabilities, which are here, are sitting at $5.7 billion. So that means that they're just barely covering off the current liabilities. They have no debt, or long-term debt, which is fine, which is good. So obviously they can't go really bankrupt here, but they're not really having that excess money to cover much more than just 1 year of upcoming expenses. So I think that's why, if you expect a longer term downturn time in the market, in the crypto asset space, then obviously you want to have that additional cash cushion to be able to weather additional costs and lower revenue, lower income coming in. So I think that's why they're making this move to just generate a bigger gap between income and expense as they're bracing for some bad times. And that's what Steve Ehrlich in the call also called out. He basically said it's, as a smart businessman, you basically look into the future, you see the headwinds, and you prepare accordingly. It's just very unfortunate that, this basically goes to the expense of us as shareholders and investors, diluting us here by 60 million, which is, it's not huge, but it's more than 10% of the existing equity. And obviously you're also looking at, so other than the share dilution, you're also offering these shares now at such a low price when others like us paid, $15, $10, $5 for it. They're offering that at around $3 price, which is very low if you compare, to the last capital raise that just happened a few months ago here. They're willing to get that additional $60 million of cash at such a low valuation. That seems to me almost like a desperate move here to get that money in, because they're basically anticipating the worst. They're anticipating trading volume to go even lower, because otherwise you wouldn't necessarily raise cash. They don't need it right now, but it seems to me that they're anticipating the upcoming months that trading volume is coming down, to now get that money right now at this stage. Although he said that May was looking like really good month, trading volume was up, but I do think that they raise cash at this point of time. It's quite concerning for me. So obviously something we have to look out for. If you're already invested, I feel for you. I feel the pain. I'm at the same sort of stage. I've invested quite early into Voyager when it was like around the $10 or $8. And then I've sold a little bit when it was around $30, when I had this huge move up when they announced Maverick partnership. But since then, I steadily held my position here to a large degree, and I've averaged down a little bit. Haven't recently bought, so I think right now we are in a sort of a, I want to see it a bit stabilizing more. I want to see what's happening in the crypto space, because that basically dictates where Voyager and where the stock is going. Because the crypto sentiment, that is what matters right now, as the company is not really generating any free cash flow here. They're in an early stage growth phase. So if you believe long term, if you believe 5-10 years out that crypto is going to be massive, there's a good chance that Voyager is going to be one of the players there and going to grab a certain percent of the market share, which obviously if they're expanding, and what sounds like to me when I listen to management, it sounds like they're expanding a lot, and then everything goes well to plan with their debit card rolling out, which generates more fees there, and then obviously them rolling out to Europe as well, increasing the customer base. So they should have a nice growth coming forward. I think they won't stop growing. It's just a matter of when is the sentiment in crypto going to shift, so that trading volume is going to go up again, and they will see those nice, dollars from increased trading volume coming in to actually not come into a bad or difficult situation here. I think if they make it through the next 1 or 2 years, we will likely see significant returns to the upside here, but the next 1 to 2 years is going to be definitely challenging. So that's why this is a high risk, high reward play. You shouldn't go overhead here. You shouldn't go overboard with your position size. You should not really go 100% all in here, as this is a highly risky position. It's a very small company, still trading as an OTC stock at the moment, and there could be anything really happening to this company. It could disappear. It could become a $10 billion company. Anything is possible. It's very uncertain at the moment. So yeah, this is obviously not advice. This is just telling you what I'm basically seeing and what I'm doing. So let me know what you think about Voyager and in the comments below, and what other stock I should be covering in the future. If you like this type of content, please consider subscribing and liking the video as well. See you next time and have a good week.